Imagine waking up tomorrow morning. You grab your phone, open your crypto app, and every token you've been holding, every position you've been sitting on, every bet you quietly made, has just been obliterated, not because of a hack, not because of a government ban, not because Elon tweeted something bizarre at 3 a.m, but because of something that was scheduled, something that was announced months ago, something that billions of dollars were quietly positioned around, and almost nobody in retail saw it coming. $4.5 billion. That's the number. $4.5 billion worth of crypto tokens, unlocked, released into the market in a single coordinated wave. A tsunami of supply hitting an ocean that might not be ready to absorb it. And the question that's keeping traders awake right now is brutally simple. Is this the beginning of the next crypto crash, or the quiet setup for the most violent pump we've seen in months? Stay with me, because by the end of this video, you're going to understand something that most retail investors never figure out, until it's already too late. And if you want deeper insights into the hidden forces shaping the global financial world, consider subscribing to Wealth Continuum. We're just getting started. But here's the thing. This isn't just a story about numbers, about supply and demand, about charts and candles. This is a story about power, about who controls the narrative in crypto markets, about the architects behind multi-billion-dollar token vesting schedules, about the institutional players who have been quietly positioning themselves on both sides of this trade. Because, yes, you can profit whether the market crashes or pumps if you know what's coming. And something unusual is happening behind the scenes right now. Something that mainstream crypto media is either missing entirely or perhaps very deliberately not covering in the right way. We're going to dig into it, all of it. The mechanics, the history, the psychology, the strategy. But first, to understand why a $4.5 billion token unlock is so significant, we need to go back to the beginning. We need to understand the architecture of modern crypto markets, and we need to meet some of the key players in this game, because this story has characters, real ones, and like any good thriller, none of them are exactly who they appear to be. Let's set the stage. On one side of this story, you have the venture capital firms and early investors, the ones who got into projects at seed stage, sometimes at fractions of a cent per token, who signed token purchase agreements with vesting schedules designed to slowly drip their holdings into the market over months, sometimes years. They've been waiting patiently, like hunters, sitting in a blind. On the other side, you have retail investors, the millions of regular people scrolling through X, at midnight, reading Telegram alpha groups, watching YouTube videos, perhaps even this one, trying to decode what the smart money is doing, trying not to be the last one holding the bag. Then there are the project teams themselves, the founders, the developers, the people who built these protocols from scratch, who also hold large token allocations, also subject to vesting schedules, also watching their own wallets with a mixture of pride and anxiety. And finally, increasingly, undeniably, there are the institutions, the hedge funds, the prop trading desks, the market makers who've built sophisticated models to front-run unlock events with surgical precision, the players who don't panic, who don't post on Reddit, who don't need to. These are the characters in our story. And the $4.5 billion token unlock? That's the event that's forcing all of them to make a move. Now, let's make sure everyone understands exactly what we're talking about, because token unlock sounds technical, intimidating, like something only a blockchain developer would care about. But the concept is actually simple, brutally simple. And once you understand it, you'll see why it matters so much. Here's the analogy. Imagine you're building a new restaurant. You've got a great concept, a great location, and you need investors. So you bring in 5 venture capital partners. You tell them, give me money now and I'll give you shares in the restaurant. But here's the deal. You can't sell your shares for the first year. After that, we'll slowly release them over the next 3 years. That's called a vesting schedule. And it exists for a very logical reason. To prevent your investors from dumping everything on day one, crashing the value of what you've built, and running away with profits while the restaurant collapses. Token vesting in crypto works exactly the same way. When a new project launches, whether it's a layer 1 blockchain, a DeFi protocol, a gaming token, whatever, the founding team, the early investors, the advisors, even sometimes the ecosystem fund, they all receive token allocations. But those allocations are locked up, frozen. They can't sell them immediately. Instead, they're released on a schedule, monthly, quarterly, sometimes all at once on a specific date, what's called a cliff unlock. And that's exactly what we're staring down right now. Multiple projects, multiple vesting schedules, multiple unlock dates, all clustering around the same window, adding up to $4.5 billion of newly liquid tokens. Think about what that means in terms of the restaurant analogy. Imagine you're a customer walking into that restaurant. Everything's going fine. The food is great. The place is buzzing. And then suddenly, 5 investors who got in at near zero cost, who've been sitting on astronomical paper gains, all received the right to sell their shares on the same day. How many of them do you think are going to hold? How many are going to cash out? How much pressure does that create on the restaurant's value? That's the unlock event. And in crypto, with its thinner liquidity than traditional markets and its heavily retail-driven sentiment, the effects can be explosive. But here's where things get strange. Because if token unlocks always caused crashes, if it was that simple, the market would have figured it out by now. Institutions would front-run every single one. Retail would know to sell ahead of time, and the pattern would eventually kill itself. But that's not what history shows us. And that is the twist in this story that almost nobody is talking about right now. Let's rewind. Because the historical data on token unlocks is genuinely fascinating and a little bit contradictory. In 2022, you had the Aptos unlock, APT tokens worth hundreds of millions of dollars released into the market. Analysts screamed crash, traders shorted, and then the token rallied. In early 2023, the SWI Foundation unlock, billions in token supply hitting the market. Bears were salivating. And then the broader market pumped. In late 2023, Arbitrum's massive ARB unlock, one of the most anticipated and feared unlock events of the year. And you know what happened? Price action was underwhelming in the best possible way. The market absorbed it. Now, I want to be careful here, because for every example like that, there are plenty of unlocks that DID crater prices. Stepien, Luna, Classic. Various DeFi tokens nobody remembers anymore because they effectively went to zero. So what separates a crash from a pump? What makes one unlock devastating and another almost irrelevant? That's the question. And the answer is more nuanced and more interesting than you might think. When institutions analyze an upcoming token unlock, they're not just looking at the raw number. 4.5 billion sounds terrifying in isolation. But smart money breaks it down into 4 key factors. Factor 1, who's unlocking? Not all token holders are created equal. If the tokens unlocking belong primarily to the project as treasury, to an ecosystem fund designed to pay developers and grow the protocol, that's very different from tokens unlocking for venture capital firms who got in at a penny. The VC, with a 10,000% paper gain, has every financial incentive on the planet to sell. The ecosystem fund? They might need to hold those tokens to execute their roadmap. So the first question is, how much is unlocking? It's who is it unlocking for? Factor 2, what's the current market sentiment? Token unlocks are not vacuum events. They happen inside a market that has a temperature, a mood, a direction. If you're dropping 4.5 billion in fresh supply into a roaring bull market, where capital is flowing in, where retail is greedy, where Bitcoin is breaking all-time highs, the market can potentially absorb it. Buy pressure meets sell pressure. Maybe things go sideways for a week. Maybe not even that. But if you drop $4.5 billion in fresh supply into a bear market, a market that's already scared, where liquidity is thin and sentiment is brittle, that's a different story. That's like dropping a boulder into a pond versus an ocean. Factor 3, on-chain behavior in the days before the unlock. Here's something most retail investors never check, but institutions watch it obsessively. What are wallets actually doing before an unlock event? Are large addresses moving tokens to exchanges, a classic sign of incoming sell pressure? Or are they moving tokens off exchanges into cold storage, a sign that holders plan to keep them? On-chain data is one of the most powerful signals in crypto, and in the weeks leading up to a major unlock, it tells a story. Sometimes that story is alarming, sometimes it's surprisingly calm. Factor 4, the unlock schedule structure. Is this a cliff unlock, where everything hits at once? Or is it a linear vesting, where tokens drip gradually into the market, day by day, week by week? A cliff unlock is the market equivalent of a fire hose. A linear vesting schedule is more like a slow drip. The psychological impact is completely different. The liquidation risk is different. The institutional response is different. So when someone says $4.5 billion token unlock, the real question is, which of these 4 factors is pointing toward disaster, and which is pointing toward resilience? And that's exactly what we're going to decode for the current situation. But first, while retail investors are currently debating whether to panic sell, institutions have already made their move. You just don't know which direction yet. Now, I want to take a brief detour, because we need to appreciate the full comedy of how this situation is being covered. Open any mainstream financial media outlet right now, Bloomberg, Reuters, CNBC. If they're covering this token unlock at all, and that's a big if, the framing is almost always the same. Crypto sell pressure incoming. Unlock event could trigger volatility. Analysts warn of downside risk. And look, they're not wrong necessarily, they're just incomplete. They're describing the weather by looking out the window instead of checking the radar. Meanwhile, on the other side of the spectrum, you've got crypto X, where every single token in this unlock event is simultaneously about to moon and about to die, depending on which influencer you follow. Half of them are long, half of them are short, and exactly 0 of them will admit they were wrong afterward. It's almost like financial media and crypto influencers share a special talent for being dramatic without being particularly informative. Funny how that works. But jokes aside, there is something genuinely significant happening here, something beyond the surface level narrative. And to understand it, we need to zoom in on the specific tokens involved. Here's where this story takes an unexpected turn. When analysts first flagged this $4.5 billion unlock event, the immediate reaction in most circles was bearish. Sell pressure incoming, get out, reduce exposure, classic response. But when you actually break down the composition of this unlock, when you look at which tokens, which projects, and who the token recipients are, a different picture starts to emerge. A significant portion of this $4.5 billion is not going to panicked VCs with paper gains looking for an exit. It's going to ecosystem funds, to protocol treasuries, to foundation wallets designed to deploy capitals to pay grants, reward contributors, fund liquidity programs, and stimulate on-chain activity. Do you see what that means? It means that a substantial chunk of this supply shock isn't going to hit the market as sell pressure. It's going to hit the market as economic activity, as protocol growth, as on-chain velocity. And here's the twist that should genuinely change how you think about this event. When a protocol treasury unlocks tokens and deploys them, pays developers, seeds liquidity pools, runs incentive programs, that doesn't just add supply, it adds demand. Because development activity attracts users. Users attract capital. Capital creates buy pressure. One hand giveth supply, and the other hand stimulates demand. This is not a simple flood. This is a controlled release, a deliberate economic mechanism designed by people who understand tokenomics far better than mainstream media gives them credit for. Does that mean everything is fine? Does that mean prices will pump? Not necessarily. Markets are chaotic. Sentiment is unpredictable. A whale can ruin your whole week. But it does mean that the simple narrative, 4.5 billion unlock equals crash, is dangerously incomplete. And almost nobody is framing it this way. But here's the real question, the one that actually matters. What are the institutions doing? Because while we sit here analyzing unlock schedules and vesting charts, the people with the biggest positions, the most sophisticated models, the deepest pockets, they've already made their bets. The trade is already on. The position is already sized. And there are 2 possible scenarios playing out right now, simultaneously, in the dark. Scenario A, the bear trap setup. Institutional players have quietly shorted the tokens scheduled for this unlock. They're counting on retail panic. They want the unlock to feel scary, because scared retail means more selling, which pushes prices down, which validates their short, which lets them cover at a profit. Then, when prices have crashed and sentiment is at maximum fear, they flip long and buy the dip. This is not a conspiracy theory. This is standard institutional playbook. It happens in traditional equity markets constantly. Stock lockup expirations often follow this exact pattern. Scenario B, the accumulation play. On the other hand, what if institutions don't want prices to crash? What if they're actually accumulating before the unlock? What if they've done their tokenomics homework? They understand that ecosystem fund tokens won't be sold, and they see the post-unlock environment as one with cleared overhang, fresh developer activity, and a cleaner technical setup. In that case, they'd be buying the fear, accumulating quietly while retail panic sells, using the narrative of massive unlock incoming as a gift, a discount window, to build positions before the next leg up. Which scenario is actually playing out? Here's the honest answer. We don't know for certain. Nobody does. But the on-chain data is starting to tell an interesting story. On-chain analytics firms have been tracking wallet movements around this unlock event. And what they're finding is not what the bearish narrative would predict. Exchange inflows for the tokens involved in this unlock, the classic signal of I'm about to dump, have actually been lower than average in the weeks leading up to the event. In some cases, measurably lower than the baseline. Meanwhile, accumulation wallets, large addresses that have historically shown buy and hold behavior, have been adding to positions. Now, I want to be careful not to overstate this. On-chain signals aren't perfect. Smart money can fake you out. Large wallets can deposit to exchanges through intermediary addresses that fly under the radar. The data is noisy, but the signal is there, and it's pointing in a direction that contradicts the panic narrative. Here's another interesting data point, options market positioning. In the derivatives, markets around the major tokens in this unlock, the skew has been shifting. Put-to-call ratios, which measure how many traders are buying protection against downside versus upside, are not as extreme as you'd expect for a market that truly believes a crash is coming. In plain English, the options market isn't particularly scared. And options traders, as a group, tend to be some of the most sophisticated participants in any financial market. When they're not loading up on downside protection, that tells you something. Does that mean everything goes to the moon? No, it means the market is genuinely uncertain, which, paradoxically, can be more bullish than bearish, because a market that's already priced in maximum fear has no room to disappoint on the downside. Let me pause for a moment and ask you something. Where are you watching from today? What time is it in your country right now? And more importantly, are you holding any of the tokens involved in this unlock? Have you already made your move? Or are you still sitting on the fence waiting for clarity that may never fully arrive? Drop it in the comments. I read them. And this conversation is worth having. Because what's happening right now in crypto is bigger than a headline. Yes, over $4.5 billion worth of tokens are unlocking this month. And events like this can trigger massive volatility. But the real story isn't just the unlock. The real story is what kind of market this unlock is happening inside. Let's zoom out. 5 years ago, institutional crypto adoption was basically a fantasy. The SEC rejected every Bitcoin ETF. Major banks publicly mocked Bitcoin. And institutional custody for crypto was legally unclear and extremely niche. But look at the world today. Bitcoin spot ETFs exist. They're approved, they're trading, and they're holding billions of dollars worth of real Bitcoin for pension funds, family offices, and retirement accounts. Ethereum ETFs followed, and the same institutions that laughed at crypto, Goldman Sachs, JP Morgan, Fidelity, are now building crypto custody and trading services. For years, banks laughed at crypto. Now suddenly they want to hold it for their clients. Interesting. And this matters for the unlock event, because in a market dominated by retail investors, a $4.5 billion token unlock is terrifying. Retail traders react emotionally. Fear spreads quickly, and panic selling can trigger massive cascades. But in a market with growing institutional participation, the dynamics are different. Institutions have the capital to absorb liquidity. They have models to price risk. And they have the patience to hold through volatility that would shake retail investors out in minutes. Institutionalization doesn't remove volatility, but it changes the character of volatility. And that changes the entire unlock narrative. Now layer something even bigger on top of that, macro. Right now, the global economy is entering a very interesting phase. Interest rates, after years of being extremely high, are widely expected to begin gradually falling. And historically, when interest rates fall, capital starts looking for risk assets. It looks for asymmetric opportunities. And crypto has often been one of those destinations. At the same time, global debt is reaching levels that would have sounded absurd a decade ago. The US is running record deficits. Emerging market currencies are under pressure, and conversations about the long-term dominance of the dollar are becoming more serious. Into this environment steps crypto, with fixed supply assets, transparent on-chain data, and increasingly institutional infrastructure. Does that mean crypto is a guaranteed safe haven? Absolutely not. Crypto is still volatile, still speculative, but the macro environment today may be more supportive for crypto than at almost any point in its history, and that context matters for this unlock event. Because the same supply shock that might have crushed prices during the fear-filled bear market of 2022 could play out very differently in a market where institutions are active and macro tailwinds are building. So what happens next? There are two main scenarios. Scenario one, the bearish outcome. Tokens unlock. Early investors or VC wallets start selling. Prices drop. Retail panics. Stop losses trigger. And suddenly, a correction spreads across the market. A 20-30% drop in specific tokens would be painful but survivable. But if contagion spreads and liquidity cracks, the correction could become far more aggressive. Scenario two, the bullish absorption. The unlock happens, and the market absorbs it. On-chain data shows accumulation. Ecosystem funds deploy capital into development, and the narrative flips. Instead of unlock equals sell pressure, the market begins to believe the overhang has finally cleared. And when a widely expected negative event doesn't happen, markets often move violently in the opposite direction. Short sellers get squeezed, sidelined capital rushes back in, and suddenly the panic narrative becomes fuel for the next rally. Now here's the uncomfortable truth. Nobody knows which scenario will happen, but the people with the most capital and the most sophisticated models have already placed their bets. The real question is whether retail figures out which direction they bet before the move happens. And that raises a very uncomfortable possibility. What if the panic narrative around this unlock is actually the setup? What if the fear on the headlines screaming about massive sell pressure is exactly what large players need? Because if you want to accumulate assets at lower prices, you need someone willing to sell them to you. I'm not saying that's what's happening, but it's a question worth asking. Because In financial markets, the consensus view is usually the view that's already priced in. And the outcome that surprises the most people is often the one that moves markets the most. But here's something even more important to remember. Not all of the $4.5 billion unlock is the same. Some of it belongs to infrastructure protocols, Layer 1 and Layer 2 networks that power the broader crypto ecosystem. Some belongs to DeFi projects with real users and real revenue, and some belongs to gaming and Web3 tokens that have thinner liquidity and more VC-heavy distributions. Each unlock has a completely different risk profile, which means blanket panic, everything will crash, is just as lazy as blind optimism. The edge comes from understanding the details, and the tools to do that are publicly available. Token unlock calendars, on-chain exchange flow data, funding rates in derivatives markets, developer activity and governance signals. Most retail investors never check these things, but they're some of the most valuable signals in crypto markets. So let me ask you something directly. Do you think institutions are quietly accumulating during this unlock? Or do you think the market really is as fragile as the headlines suggest? Tell me in the comments. I'm genuinely curious, because what we're watching right now might actually be something bigger than a token unlock. We might be watching crypto markets mature in real time, messy, volatile, sometimes chaotic, but slowly evolving into a financial system with deeper liquidity, stronger infrastructure, and broader participation. A market that can absorb a $4.5 billion supply event without collapsing is a market that's growing up. And if it can't, then we're still in the early chapters of crypto's evolution. Either way, this moment is informative. The tokens are unlocking, positions are being adjusted, institutions are watching the data, and somewhere in offices around the world, maybe New York, Singapore, or Geneva, people managing billions are making decisions that could determine which direction this breaks. If the market absorbs the supply, the rally could be violent. If the bears are right, the opportunity will eventually come on the other side of fear, because every crypto winter so far has eventually been followed by a spring, every single time. History isn't a guarantee, but it is a pattern, and patterns are how we navigate uncertain markets. So here we are, 4.5 billion in tokens unlocking, a divided market narrative, institutional capital entering crypto, and macro forces shifting beneath everything. The simple story is panic, but the real story is far more interesting, and it's a story worth paying attention to. If you made it this far, thank you. This is the kind of content I care about making: real analysis, real context, and perspectives that go beyond the headlines. If that's the kind of thinking you value, subscribe to Wealth Continuum. And trust me, the next video is going to be even bigger. Until then, stay informed, stay rational, and stay ahead.